High interest rates still a problem, but markets are improving based on the data and the science. Yeah, just the data. Let's get into it. Let's see what the MLS is saying for stats for July. Here we go. So here's a quick recap. High mortgage interest rates continue to be a drag on home sales, discouraging both potential buyers facing high-rate mortgages and would-be sellers wanting to keep their low-rate mortgages so they're not selling their homes. However, there are signs that the housing market is loosening up and that interest rates are declining and likely to decline even further in the coming months. Let's check that out. So today's 15 and 30-year mortgage rates hold at lowest level in over a year. This is as a couple of days ago. Median interest rate on a 30-year fixed rate mortgage is 6.49% as of August 13th. So call it 6.5%, which is unchanged from yesterday. Additionally, the median interest rate on a 15-year rate mortgage is 5.6. Those are as low as we've had for a long, long time. What you're going to see happen is that the low rates are being built into the mortgage market right now because it's understood that even though the Fed just met and they didn't do anything, even though a lot of people were calling for a short-term for an emergency rate cut, because we had that market meltdown a couple of Mondays ago. Remember that financial market just went crazy, and it's because of the Japanese market, the repurchase market, I think it was, one of those things. It just roiled all the other markets, United States market, and at the same time. So people want to have the Fed, lower rates to create some more stability in the marketplace. Cheaper money makes things able to make to run better economically. And so what you've got going on is you got some rates coming down. This is based on the fact that we think the Fed will probably drop rates in September. And, there's been a high probability of that all throughout this process in 2024. I don't think they'll do anything quarter one. I don't think they'll do anything quarter two, but maybe, just maybe, there's a less than 25% chance they'll do a little bit of easing in September. October is kind of what's been predicted. And here we are. And just because of circumstances, the way the market's gone, it looks like that is a thing. And so mortgage rates have been dipping in the last month or so. Home sales are up 5.9% year over year in the MLS market area. Yay! All right. Well, no, don't cheer for that because home sales are at some super, super low rates because home sellers don't want to stick their home on the market because then they have to either pay cash for wherever they're going or they have to take out a mortgage on something that's way higher than maybe the 2.75% or the 3% or the even 4% or even the 5%. Because mortgage rates have been, close to 8%. They bumped up to close to 8%. They're in that 7% for a long time. And those are numbers that are way higher than what buyers and sellers have experienced as recently as, even just a couple of years ago. July of 2022 is where I see the market really starting to retract, real estate market. And it's been a tough go since then because rates just went through the roof after coming off some all-time lows under 3% there for a short period of time. So 5.9% year over year increase in sales. Number of active listings. This is the one. Increased 37.7%. So you've got all these listings coming on the market. But remember, 37.7% increase is relative to last year at this same time where we had basically no inventory. All the markets were essentially sold out. There was like a month and something of inventory, which is anything under 2 months I consider sold out, meaning that if you didn't put any more homes on the market, it would only take 5 weeks, 6 weeks to sell out everything. Boom, everything would be gone. That's the theory, right? 4 to 6 months of inventory is considered normal. We haven't had that in years. So the 37.7 increase in total number of properties listed, yet 15,000 and change active listings, July of 2024 compared to just a hair under 11,000 end of July 2023. So big increase, but relative to a normal market, we're still not there. And the market is reacting positively. I think you're seeing a little bit of uptick where the data won't show that right now as buyers are kind of jumping in going, oh, Yeah, we're going to lock this rate in and we're going to gamble on the fact that we're going to buy this house, do whatever. We're going to gamble on the rates now. We're going to take that rate. We know we can afford that. And then we'll refinance it when lower rates finally come around, which they probably will. The 6 counties with the highest increases in inventory for sale were Douglas, Pierce, Walla Walla, Lewis, Snohomish, and Mason. Some outer lying counties. Notice King County isn't in there. Pierce and Snohomish are. And Snohomish up almost 48% in inventory. Some crazy numbers. Here's one of the big kickers that has been slowing the market down is that even though we've had these interest rates that bumped up multiple points over a short period of time, there's still enough buyer demand out there with as little inventory as there is to increase prices. So pay attention to this one. Overall, the median price for residential homes and condominiums, that's everything, sold in July 2024, system-wide, was $650K, an increase of 5.7% when compared to July of 2023, when it was $615,000. So even though you've got this big jump in rates and all of a sudden, nobody wants to put their house on the market and the number of closed sales, number of pending sales have all dropped substantially. I mean, huge numbers down. Prices still went up 6%, basically 6% year over year. So imagine what happens to that pricing when your interest rates start to get down into the 5s-ish. Yeah, you're going to see some crazy spiked up numbers as far as appreciation goes. And that's system wide. So you've got some markets that, statistically haven't done much, but then you've got other markets closer into the urban centers with the employment that are going gangbusters because you still got that demand. You've still got those jobs, still got those people wanting homes, buying homes that are gambling on, we'll buy it now, we'll fall in love with the home, not the mortgage, and then we'll refinance that mortgage out down the road and we'll be even more affordable. So, they're patting themselves on the back, taking their mortgage advisor's advice, and they're doing something, which is not bad advice depending on if you can afford the mortgage with the higher rates right now and be even in better shape down the road. So that is kind of the big gamble. So although the Federal Open Market Committee, the FOMC of the Federal Reserve Bank, did not lower rates in its July 31st meeting, it suggested it might do so in mid-September. Is it going to do a half-point reduction? Probably. A weak jobs report, largely reflecting a growing labor force combined with low inflation, suggests that the Fed will indeed lower rates next month with additional rate cuts expected at subsequent meetings. Yeah, maybe. I think we see a half-point pop, but that's on the heels of mortgage rates already coming down. It's probably some more bad news coming in because if, when it's bad news, then the Fed reacts and goes, oh, this isn't working out the way we thought it would. That's when they make their move and because they're making a defensive move. So what will happen? I think we'll see a rate cut, but most of that rate cut will already be priced into the mortgage market. That's just my opinion. It's my opinion after following this stuff for 30 something years. Yeah. Anyway. All right. That's it for me on this one. Thanks so much for being here. I'll catch up with you in the next one and love to have you subscribe, do all that good stuff. I'll see you next time. Bye for now.